Welcome to the FP Markets Finding a Rule-Based System, Building a Trading Plan. This is educational material and is prepared for general guidance only and does not constitute financial product advice, nor does it take into account your investment objectives, financial situation, or particular needs. Please contact a licensed advisor before acting on the information contained. Welcome to Building a Trading Plan, Understanding Risk and Return. Trading can be as hard or as easy as you make it. The reality is that traders just need to survive the learning curve to get an understanding of what works for them and how to approach the market. Along the way you will make mistakes, which is inevitable. You will also be wrong. It is rather sobering, but this is all part of the learning curve. The successful and improved traders prove that you can be successful in the market if you just learn from your mistakes. No matter how successful you are, you must learn from your mistakes. We hope this webinar will identify some common traps and make you better prepared in your own journey. Use your mistakes in your own self-advancement to trading success. Markets are made up of thousands of participants around the globe, both individual, corporate, each acting for their own reasons. The equities market, the futures market, the FX market, all have participants acting for their own reasons. The decisions made by these participants show up in the price movements of individual shares, individual futures contracts, and individual FX movements. As new information comes to the market via media reports or company-specific media releases, so individuals react to this information based on their own decision making. And as we do not know what is going to happen in the future, a trading plan is required to give a response to the coming future movements in price. So prediction is not a trading plan. There is no such thing as a trade having a probability of working. Each trade is either 0 or 100%. It either works or it does not work. Looking for the next best trading system will undo your long-term commitment. Many traders, when they first approach the market, look at different products and try one, try another, try this system, try that system, eventually wasting a considerable amount of time only to come back to the start. Now, finding a rule-based system. A trader must know why a strategy makes money. In building a rule-based system, we must understand why a strategy makes money. We must understand the weakness of the strategy, and in conjunction with the market, it should be in sync with the market. A strategy should be in sync with the market, so we need a basic understanding of the market itself. Trading with leverage and margin can be very effective or not. If you take positions that are too big for your account, for example, if you use 50% more of your margin in one position, you will fail at trading. This has been proven over and over. It is the number one killer of trading accounts, is over leverage in the market. If you trade out of emotional need like ego or revenge, you will fail in the markets. This has also been proven to be true. If you constantly try and catch a falling knife, try and constantly catch falling prices without evidence of a turnaround, you will fail in the market. If you double up on a falling price, you will fail in the market. Building losing positions, you will fail in the market. And when we fail, it looks like this. As human beings, on the top left-hand corner, we do the work, we do the investigation, we take the action, we take the trade, and make the decision. Along the way, we monitor the progress of that position. Is it working for us? Is it not? Ultimately, we get the result and its implication. The trade either works or it does not work. And then we come to this crossroads where was the result as expected? If the result was as expected, then the answer is yes. No action is required, and we feel pretty good about the whole thing. If the answer is no, as human beings, we tend to go on and play the blame game about what works, who didn't do their job, where did I get the information, who created the situation where I failed, what can I do, who can I call or email or text, where can I place the blame. As human beings, we tend to try and manipulate outcomes after the outcome. It works in most parts of our lives, but in trading it simply does not work. So it's okay to fail, but learn from the mistakes. The attributes of a trader or attributes of trading is not related to anything else we do in our daily lives. Trading is very different to what we do in our daily lives. Trading is very much black and white in a lot of cases. Trade with a single thought, not the committee of voices that sits on your shoulder and asks you to go and check this, check that. It'll come back, it'll do this, it'll do that. That's the committee. The committee doesn't trade, you trade. So we waste the time with all these thoughts, these committee thoughts. We need to monitor our thoughts as the market is open and going. There is a path that is right for you. So in the beginning of building a trading plan looks like this. One simple concept is that we have a trading plan that is essentially a business plan. So the first thing we need to ask ourselves is, what are the running costs, the internet costs each month, the accounting costs each year, the data feed, that if we're buying data, a data stream, what are the costs of that data feed? The interest on bank, if we're using leveraged money, what is the interest rate? All of these costs will have to be added into our trading business plan. If we're going to the bank to borrow money to start a business, the first thing they'll ask you is, do you have a business plan? And that business plan would include all of these items, as any business plan does, the costs of actually running the business before you make a dollar. The concept of risk and the concept of return. Return is a part of risk. So risk management of a trading account. In a trade, if a trade is opened, in this example here, a trade is opened at $7.16 at the top of the candle here on the right hand side. A position is taken at $7.16. When the trade is open, we identify our stop level at $6.80, which is the low of the previous trading period. So this is part of our trading plan. We decide that our risk now is 36 cents. The entry price of $7.16 down to our loss of $6.80 equals 36 cents. This risk is now a component of this trade only. Each individual stock, each individual futures contract, each FX cross will have its own levels of stop loss attached to it. The stop loss is the risk part of the trade. We've assigned 36 cents of risk to this trade. This becomes our stop loss. Now this risk can be now equated as R1. If R is called 1, then whatever happens after that can be a factor of that risk. So in this case, if R equals 36 cents, so if the trade loses 36 cents, we then record a minus 1R trade. If the trade goes on to make a profit, R equals 36 cents. So if the trade makes 36 cents of profit, we record then an R plus 1. If the trade goes on to make a $2 profit, we divide our $2 by our initial risk of 36 cents and we record an R 5.5 plus. A positive R value after several trades will lead to an expectancy of future trades. As an example of position size, if our starting capital is $100,000 and we decide that we're going to assign 0.5% of our account to each trade as risk, my potential stop loss risk is $500. This as a percentage of the account is 0.5%. The position size can now be calculated as $500 divided by our initial stop loss value of 36 cents gives us 1,388 units. The trade value now is 1,388 units times the entry price of $7.36 gives us a trade value of 10,216 units. This cash is applied to the trade. Keeping in mind R risk, R return. The risk of the trade can then be equated to the return of the trade. So the stop loss risk is $500, as percentage of the account is 0.5%. As the trade gets entered, we don't know what the return is going to be. But for every 36 cents of gain, the return equals 1. In a margin account, same starting capital, $100,000. We're going to assign $500 of risk to our stop loss. As a percentage of the account, this is still 0.5%. In this particular instrument, the margin is $1.10 per CFD. So for 1,388 units, we assign $1,526 to our margin as cash. Risk and return. Risk can be quoted as a percentage of the return. In this case, 1,388 times 36 cents again is $500 of risk. The stop loss is $500. The percentage of the account is 0.5. Return equals R. We don't know what the return is on the entry of the trade. But for every 36 cents of gain, the return equals 1. In this example, on the left-hand side, we've assigned 36 cents of risk. This becomes an R1 value. We've assigned 0.5% of the account. The actual trade, when it was closed, produced 72-cent profit. So this is now recorded as an R2 profit. That's the 72 cents divided by our 36 cents of risk gives us 2, an R2 profit. It's recorded into our trade journal. As we build our trade journal with a series of trades, our first trade on the top line, we've produced a 72-cent profit. It's recorded in our profit and loss as a $1,000 profit. A subsequent trade is taken and we've identified 25 cents of risk in this trade. This 25 cents becomes our R value. It allows us at 25 cents, we're risking $500, the same percentage of our account, allows us to buy 2,000 units of this particular instrument. If the trade went on to hit our stop loss at 25 cents, we would record a minus R1 trade, minus $500 from our trading account. So far, overall, we have a positive R1 in our account. Developing the trading plan rules. Most successful market professionals achieve success by controlling risk. Controlling risk goes against our natural tendencies. Risk control requires tremendous internal control. Most successful speculators have a success rate of 35 to 50%. They are not successful because they predict prices well. They are successful because the size of their profitable trades far exceeds the size of their losses. This requires tremendous internal control. Most successful conservative investors are contrarians. They do what everyone else is afraid to do. They have patience and are willing to wait for the right opportunity. This also requires internal control. Van Tharp quote. When we look at the markets, there is two approaches generally taken, a fundamental or a technical approach. So without being skilled in understanding financial reports, there are many programs available to the trader that will assist in the selection of stocks with sound financials. VectorVest is one such program. VectorVest rates stocks on a VST score. As a high VST score, the stock becomes more attractive. A VST is a summary of their background calculations of relative value, relative safety, and relative timing, which is the financials of the company, the profitability of the company, and whereabouts in a technical trend it is. And they rate that together to give it a VST score. This is updated every day. And one method of looking at the financial health of stocks is with a program VectorVest. So in defining a technical rule-based system, the trader must do some real work on what's appropriate for the desired trading plan. This type of rule-based system will require some basic starting guidelines. For example, decide what type of market this system will be based on, including the amount of actual time that will be allocated to implementing the rule-based trading system in the selected market. Select the time frame, whether you're working in a daily time frame, an hourly time frame, or longer time frames like weekly for the implementation of the trading system. Select the technical method of price or combination of price using an indicator. A rule-based trading system called a trading plan could look like this. The amount of money in my account, $100,000. The type of market I will trade is Australian equities. The amount of time that I will commit to this is 2 hours per day. So examples of a rule-based trading system, when we start to put some rules together and back test our system visually, is a good place to start. We need to then understand what is my potential risk reward. We need to understand a little bit about the volatility of the market, about price movements of individual stocks, and go back in time and apply our rules to the share chart. One way of working out, a very simple way of working out risk or potential risk, is with an average true range. While individual prices move around on the buying and selling from traders and investors, it is wise to have some measure of the possible day-to-day risk in price movement. An ATR, average true range indicator, is useful to give some context to the potential future price movements. A very simple method of gauging market volatility is taking notice of the average true range over an average of 2 days. In this example, an ATR comes back with a value of 26 cents and the stock price of $5.60. Therefore, the volatility risk is 26 cents divided by $5.60 will give you a potential 4.6% movement for 2 days. This needs to be worked back into your margin calculations and your account size to see if this stock is suitable for your trading plan. So a simple rule-based system. Let's take a look at a very simple rule-based system. Rule-based system 1 with indicators. In this example here, we're using a daily time frame. This requires about an hour a day at the market open and an hour at the market close. So the first rule is we're going to buy when the price closes in the top 25% of the daily range, and also when the price bar is above a 50-day and a 20-day moving average. So the 20-day must be above the 50-day and the price bar must be above both of those averages. End of the trading time frame type of trading is the second rule. Rule 2, a stop loss is taken when the market trades below the pivot point low, and the pivot point low is the low of each day. This can be adjusted to avoid being stopped too early if the trade gets underway. But essentially in this example here, the entry is taken at this point, the price is closed in here, it is above the average. On this particular day the price is closed in the top 25% of the range. The next day the trade has moved forward, the next day the trade has moved forward, and the day after that it has closed below the low of that day. The stop is set at the low of each day, so it's formed a pivot and taken you out of the market. And this can simply be reapplied again when the price is above the 20-day average and the 50-day average. An entry can be taken and the stop moved underneath the low of the previous day until eventually you're stopped on the move. In this particular trading rule-based system, you will either be stopped straight away or within a few days. A second rule-based system is with indicators. Buy and hold with indicators remain positive. In this example, the time frame again is daily. It requires an hour at the market open, an hour at the market close. So rule 1, buy and hold when the relative strength indicator set at 14 moves above 50. Confirmed by commodities channel indicator, CCI, set at 20. When that moves above 0, gives you an entry signal. And conversely, the second rule is a stop is taken when either the RSI or the CCI crosses below their respective signal lines. In this example, an entry is taken at these points here where the two indicators confirm each other, and an exit is taken at some point in the future when either the RSI crosses below its signal line of 50 or the CCI crosses below its signal line of 0. An effective trading plan. The third one is the rule-based system number 3. This is essentially a little bit of chart analysis in here. The time frame is a weekly chart and a daily time frame is required. 1 hour at the market open, 1 hour at the market close. A price-based rule system can be developed on the observation of chart signals in the shape of a candle or the open, high, low, close bar. In this example, a pivot point trading system is ideal when used with a setup in the price movement. This method can look for the day of balance in the price movement, described in a candle chart as the doji candle, or where the price of the open is the same as the price closing price for the session. Rule 1. Wait for the doji. This can take days or weeks, but wait for the doji to be displayed in the price chart. Then take a position when the price closes above the high price of the doji in the following price action, when the price closes above the high price of the doji. In this example, this is our doji line here. The following day the price moved above the high price but failed to close above the high price. The next day was an inside day to the doji. The day following that we had a breakout across our entry line, across our high price of our doji right here, and the trade is taken on the close of that day. Again, stop loss rule can be either a break of the low, so the stops are moved underneath the low, 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 and you're eventually stopped out at this level. A very effective trading system. So this shows the stop. The stop for this type of price movement should also be set for the following price action. The first stop is set off the low of the entry doji. The stop is then moved up underneath the low of each trading period until stopped out. So our initial stop is down here at the low of the doji. Our entry is above the high of the doji, closing price above the high of the doji, and our stop level is moved up underneath every bar until we eventually stopped out. A very effective trading system. So hopefully that gives you some insight into building a trading plan. A trading plan is just simply some really basic rules that you can apply to the market, that you can visually backtest if you have to, or you can mechanically backtest if you have these systems built to do that. I wish you every success in the market, but you must build a trading system. The important message is any rule-based trading system should be simple to understand and operate. If we all went about our business without rules, there would be chaos and extreme risk for our financial well-being. Understanding that risk is part of the business of trading and controlling that risk is a good business planning. It's not having to know when you are right or wrong, but how you manage the outcome will determine your success as a trader. If there is a secret to trading success, then it is simply cutting losses quickly and letting profits run. Traders, I wish you every success in your journey and look forward to catching up with you soon.